Joining me now in a Box Business exclusive, Guggenheim Partners Investment Management CIO, Ann Walsh. And if the Fed were to cave or to give in to the president's request for cutting up to 200 basis points off what right now is the 4.25% to 4.5% Fed funds rate, how would the world markets and the U.S. markets respond? Because, you know, some people look at rate cuts as a sign of distress.
Right. So, Liz, it's great to see you. We're at a very interesting and, dare I say, precarious time in the world. I believe that the U.S. economy is slowing. It's already been slowing. We're going to continue to see a glide path down to lower GDP. So that's the first part. The second part is that we are seeing inflation on a deflationary path, maybe disinflationary path. And so there's actually room for the Fed to cut. But overarching all of this is their desire to remain independent and to be seen with a high degree of credibility. And the key to that is that they really believe they have to see the core PCE down to the 2% level that they set the target at originally. And until they get there, they're less likely to be actively seeking to lower rates.
Here's what makes me a little concerned about the Federal Reserve taking such a stand. And by the way, since March of 2022, when they were raising rates and then they began cutting pretty dramatically because we had inflation in June of 22, four-decade highs. I mean, it was nuts. We're not there anymore. So why should rates still be that high? And if they're trying to show their independence, is that cutting off your nose to spite your face by not chopping interest rates?
Actually, I think it is a bit of that. Based on the Taylor rule, the model suggests that we should be 50 to 75 basis points lower on Fed funds rate to get to neutral. And let's think about what happened to force and bring on all that inflation. It was a huge amount of fiscal and monetary stimulus to recover from COVID. That impetus in that money supply has slowly eased out of the system. Mm-hmm. And so where we are right now is not in a monetary inflationary environment. The concern that the Fed's expressing is about tariffs. So the inflation caused by the cost of goods increasing. But I think in our view is that these tariffs are much more recessionary in their impact. It slows down consumer demand and it slows down the economy. And so I think that at the end of the day, we're going to see that the tariff impact is not going to be either as large or as extended as might be in the minds of Fed officials.
What is the investment opportunity right now, knowing that the Fed is pretty intransigent, kind of hanging out in the quicksand, well, not quicksand, but let's just say a little bit of mud at the moment, not moving on rates, and knowing that the president is very serious about tariffs and making what he feels an unfair landscape when it comes to trade more fair by charging other countries?
Right. So in times like this, which this is a very tricky investment environment, frankly, I haven't seen one this complicated in many, many years,
really?
If ever. But when I have environments like this, when I think about what's the best way to approach them, is to look at the fundamentals. So what are good investments? Well, the macro themes, which was already mentioned before, artificial intelligence, earlier in your show, and I think that's an important theme. Investment in energy and the tech build out and telecommunications and all the things that we need as a business environment. That's first. Second, in terms of rates, well, you're getting paid a lot to be in treasuries and to be in investment grade fixed income in particular. And that is, you're getting real rate of interest for a change, and you're getting a term premium. So all of that actually makes fixed income a really good opportunity right now, particularly in credit. Because what's also happening in the backdrop is that companies are in pretty darn good shape. Those companies that issue bonds and that are available to investors today. Now, I would sort of say there's a bit of a risk here, and that is that the lower end consumer and the small businesses are struggling in this high interest rate environment. And where Jay Powell said that they were moderately or modestly restrictive, I think they're more than that, really? Particularly for the interest sensitive parts of the economy. And that's where the pressure points are going to continue to be felt.
Yeah, we've seen some housing numbers that have not looked that happy. And in fact, we start to wonder what's going on in the housing market. And you start to see that it's really been hard for buyers because rates are still historically high, although they came down week over week. Freddie Mac had just indicated that. We're still below 7%. But so overall, the criticism that the president made in that first soundbite is rational in a way because it costs so much to service the debt when rates are this high, just paying the interest on the debt. But then the name calling, and that actually came up during the Federal Reserve news conference just in the last 40 minutes. And we want to play what was asked and how Chair Powell responded. Listen.
From my standpoint, it's not complicated. What everyone on the FOMC wants is a good, solid American economy with a strong labor market and price stability. That's what we want. We think our policy is well positioned right now to deliver that and to be able to respond in a timely way as the data lead us around. The economy's been resilient, and part of that is our stance. And again, we think we're in a good place on that to respond to significant economic developments. That's what matters. That is what matters to us.
And what do you think?
Well, again, I think they really, really want to maintain independence and the credibility around that. But that actually should mean that they would even drown out the insults and the language from the president and just say, okay, maybe, he has his point because he's the president and he has, he's trying to guide the entire U.S. economy and the government. But he's also right because we're too tight.
Do you think the Fed should have cut today?
Well, I do. I think that there was room for 25 basis points. And I would also make another point that's very important, and that is we have to look at the Fed has more than one tool in their toolkit. Everything has been focused on rates since COVID. And the reality is they've got a very, very sizable balance sheet. Mm-hmm. And they started to ease off on QT some time ago. Perhaps they should have said QT is a better tool.
Quantitative tightening.
Exactly, is a way better tool. Keep the balance sheet shrinking relative to keeping rates high. They have a disproportionate impact on the economy. The most interest-sensitive parts of the economy, whether that's housing or the lower-end consumer, or again, those small businesses, were being harmed more by the rate action and would have been less impacted by the balance sheet reduction. And I think with that, they didn't really seem to act the way they might have been able to if they'd really thought about those two tools and how they could use both of them. So now it's only about rates because the quantitative tightening is almost done. Mm-hmm. And so it's only about rates, and I think that from a policy perspective, there's more that they could have done and in a different fashion. But yes, they should have lowered 25 basis points.
Anne Walsh, Guggenheim, thank you so very much. And I just need our viewers to know Anne is just one of the power players that you will see every day here on the Claman Countdown.